Good afternoon, this is Connor from 0DTE Traders here to present our market minute for October 13th, 2023. It is about 1:20 here and the SPX is down 0.6% to 43.26. Definitely bearish here today. We have VIX spiking plus 20%, just at that 20 handle. We have mega caps growth underperforming, so definitely a risk-off indication here. And this is largely in response to the consumer sentiment data, as well as a geopolitical headline that came across the wire at the exact same time, so 10 o'clock. And that was our cue to go short. I opted for long puts, selling out into weakness. You could have sold calls or bought our downside butterfly at 43.20, which we're basically trading there right now. And of course, we think there's good pinning potential at that strike. Now this is, I would say, significant support here. This was the low yesterday. We've tested it once today. This is the third test. So the more times you test the level, the more prone it is to a break, in this case a breakdown. So if we do see continued downside, we'd be looking for major support here at 4,300. And then if you break 4,300, that's definitely a risk off indication. Which would imply a move back down to 4,200. Not today, of course, but perhaps next week if that does occur. On the upside, we have 43.40, which is quite significant here in terms of options positioning. This is the neutral strike. And then you have 43.50 above that, which is also a fairly balanced strike in terms of gamma. And is basically the pivot in the larger range here, right? We got 4,400 is our call wall and upper bound, and 4,300 is major support. So this is really the pivot, the fair value type of zone here. And we know the market is bearish today, but if we take this into context, right? If we look at positioning, we're at this transitional phase where gamma is basically zero, right? We're close to that flip level. If we are in negative gamma, which we have been over the past 2 months, that's bearish, right? It's a market dominated by puts, the bears, where we expect higher volatility, less liquidity, destabilizing price action, and that's exactly what we got here over the past couple months. Now, if we can push into positive territory and we start to come into a call-dominated market, things could become a little bit more easier. We'll see that dip buy trade start to return and more stabilizing type environment. Now, speaking about gamma and being quite neutral, that means the option expiration here for October 20th is quite balanced at this juncture. Now, there's quite a bit of time here to sway one way or the other, and it definitely will. Now, which way is that going to be? I mean, we'll find out. I think probably lower. Just given sort of the macro environment. However, option expiration tends to print highs or lows in markets. It's where we often see sort of a change in market regimes or a change in sentiment, largely sparked by flows. So if it's a positive gamma OpEx, very often we see market highs get printed. Usually see a week or two of weakness or at least some chop type action after the option expiration. Whereas a negative gamma tends to print local lows in the market and you start to get the unwind of those puts. You see it here in August, you see it here in March, and again in January. So it gives us a lot of insight into what we could expect in that last week of option expiration, where the pinning potential is, and what we could expect going forward, that week or two after the option expiration. A lot of edge looking at this data. Now, just going back to our SPX chart, we can see that the market is breaking down here. We are indeed breaking 4,300. Now, something I want to point out here is if the market is very one-sided, which it clearly is today, with VIX, I believe is up 24% now. Yeah, 23%. If you miss the initial move, you don't want to be chasing at lows here. If you're patient, you very often get sort of an afternoon trend continuation setup. 12:30, 1 o'clock-ish. Today it occurred at 12:30. We had a cycle high, so market was overbought on the 5-minute time frame. We were back testing major Support now, or sorry, major resistance was support at 43.50, and we're seeing that continuation. So I know there's always a tendency to want to buy these dips, but when the market is so one-sided, be patient, wait for that bounce, and take it short. I don't see any catalyst at this juncture to sort of shift market sentiment. Now, of course, something could come across the wire and, spark a rally, definitely possible, but there's no known catalyst. And the market has been influenced by catalysts. There's a lot of fear, uncertainty, overreaction in the market. If we go back to Monday, we can see that the morning session was quite benign. However, afternoon comments by Fed officials, dovish comments sparked a squeeze rally. Same thing on Tuesday, dovish Fed comments sparked a squeeze rally. Now, this is important here, right? Why is this sparking such a squeeze rally? Two reasons. Positioning has been completely one-sided, right? So there's a lot of puts in the market. So when you get a move higher and you get a contraction in implied volatility, those options are going to get repriced lower. It's going to force participants to either monetize those puts or those puts lose value and dealers have to be buyers. Regardless of the monetization or the loss in value, it equates to buy flows in the market. And this is why you get those squeeze-like conditions from a negative gamma state. The second reason is really since the FOMC, there's been nothing but hawkish comments, right? So the dovish comments was definitely a change of pace and, sparked probably some call buying along with that. However, on Tuesday, that rally was not sustained, right? So the squeeze got killed by a geopolitical headline right here. You had that sharp sell-off. Now, this was good for us because it came right down and we pinned our 43.60 strike that day. But, just being completely influenced by headlines here. Now, on Wednesday, the market bled lower in response to PPI data, which did come in hot. However, that reversed on FOMC minutes. Thursday, the market was quite benign here, despite a hotter than expected CPI. However, a weak bond auction caused that risk-off move, huge spike in yields, and today, consumer sentiment report, right? So when we're in this environment where there's a lot of fear, uncertainty, a lot of dynamics going on in the macro geopolitical front, you gotta stay up to date with what's coming across the wire. We've been really stressing this point to our traders. I probably sound like a broken record. I've said it so much in our AM meetings as well as our market notes, but keep the news feed up, stay vigilant, be adaptive, and essentially trade the headlines. If it's negative, be short. If it's positive, be long, and then just be a little bit more defensive if you're playing counter to that headline. In terms of strategies, how I've been navigating this environment is by trading just single options, which I had some. Let's go to Monday here. So long calls. I did trade a couple butterflies here for some decent winners, but no home runs. But I did have some nice trades here on single options, calls and puts, Wednesday, Friday. And I'm getting solid gains on these 200, 190% ROI. But the reason I'm opting for the single options is if something comes across the wire and it's against my position, it allows me to easily get out of the trade. I can bail real quick. Commissions are cheap. There's a lot of liquidity, tight spreads, and I can close the trade. I can flip the direction. And of course, if I'm trading these in the direction of the catalyst, I can be patient on it because I know there's a reason to sell. I know there's a reason to buy. Whereas if you're trading credit spreads, it could be a little bit challenging. You get a catalyst, you can find yourself in a very tough situation really quick. Now, I have a general rule where I just don't trade credit spreads when we're in negative gamma. Butterflies tend to be very, very tend to do well in this environment as well, right? Negative gamma, high volatility, good directional type movement. However, the problem with the long butterfly is that the spreads could be a little bit of a challenge, right? The bid ask is wide. If the market does move quick, you could find some challenges to get out, at least at a decent price. So I like the long options. It's been working quite well for me here over the past couple months. And even if I'm wrong on the trade, the way I enter them, so the strategy I implement, allows me to identify really quick if I'm wrong to get out of the trade. So I did have a loser on long calls here on Wednesday. It was my first trade. I lost, but only at negative 17% ROI. I re-entered the same trade, maybe 20 minutes later, and that was the big winner. I mean, these went up really high, right? So I always scale in and out of my trades. So I do sacrifice the ROI. However, really quick, I get into that no-lose scenario, and that tends to help me keep the win rate up and just keep my confidence elevated. So single options, they're good in some environments, they're terrible in others, but when you get the volatility, negative gamma, they tend to perform well. So I recommend playing around with them because there's good reward potential and minimal loss if you manage it properly. Anyways, that's all I have for you guys. If you want to learn more, visit our website at 0DTEtraders.com and consider becoming a member. Hope to see you soon.